Hey folks, Dan Friel here, trying to educate you guys on the economics behind real estate, where we talk about economic events taking place today that's going to shape real estate today, tomorrow, weeks, and months to come. So what we focus in on is the economic data coming in that's moving the markets. So without further ado, let's get to it. What you're seeing on your screen right now is where mortgage rates are right now, but I'm going to get to that in just a minute. Let's get over to the economic calendar shaping the markets for today. You go through here and it's Friday, the September 8th, and there is no data. So this is going to give us a little bit of time now to talk about why I think the Federal Reserve is done raising rates, and their next move is probably going to be to start reducing rates. So let's get over to my thoughts. The first thing we want to look at is right here, where inflation is right here today. So let me get my head out of the screen. What you're seeing on the screen right through here is where the inflation number is, where our inflation is at 3.3%. Now the buzzword on the street is the Federal Reserve wants to get this in the twos. They'd love to have it at 2% right on the button, but they're striving to get this into the twos. So let me explain to you guys why I think they're done. Let's get over to the next screen. The next screen is telling us where the inflation is, the CPI. Now let's first explain what the CPI is. CPI is consumer inflation. Okay, so these are the things that we use and function with and how much they've risen in price year over year. So you start with all items. Those are up a little over 3%. And then you go over to energy. That's skyrocketing right now. It's up 30%. You got food up 10%, new vehicle sales up 10%. But right here is the shelter piece. The shelter piece is what we're going to focus in on. Why? Well, this piece of the puzzle really makes up 40% of the CPI numbers. Okay, so let's look at this. And I want to break this down. This number right here represents 5.7%. There's a 5.7% increase year over year in shelter. Well, to come up with this number right here that the Federal Reserve is using at 3.3, the number that they're using on this for the shelter number is 8%. 8%. So 8% is the shelter number factored in here. Well, if you really make that adjustment from 8% to the 5.7% that's effective right here, what you're going to come up with is a CPI number in the high twos. So that is fantastic numbers. So let me explain what I just went over. If you have an inflation number at 3-point-something%, and 40% of that number actually went down almost 3%, that number is going to plummet. So we're going to see inflation levels in the 2%, where the Federal Reserve is going to be applauding things. But there's more to this puzzle than just meets the eye. What I want to focus in on next is where I think, or basically why I think the Federal Reserve is also done. Well, people are starting to spend less, and let me explain why. Here's how people have been spending over the last few years, especially since the pandemic. Can you see this chart? It just went from here, and it just went up and up and up and up and up, and then it started to stagnate. Okay, well, this is what caused inflation. People were buying and buying and buying. They were buying on debt, and they were also buying with cash, a lot of cash reserves that they had built up over the pandemic. And I'm going to explain that here in a second as well. So you have people just spending like crazy all through this, and then all of a sudden it just stopped. Okay. The next chart we want to see right here is disposable income. This is how much money you and I had in the bank during the last several years. So if you look at this chart, you're going to see, well, let's just go back even further. Let's go back to 10 years. Okay. So here's how people have saved over the last 10 years. Every year people would save as much money as they can. And it just trickled along. And here's the savings rates. And they got money. And then all of a sudden in 2020, what happened? What happened? Well, the world shut down. Well, what all of a sudden made people get this much disposable income? The most ever in history. Let me go to the max chart. Here's the max chart back from when they started this study. So you go through here, and like I said, Americans, we were trying to make a better life for our families and everybody else. So we're saving. Then all of a sudden you microscope into this, and you had the highest savings rates ever in history. Well, what happened during this time? The pandemic. Why did this cause such a massive implosion or explosion in consumers having so much money? Well, think about it. During this time frame, the Federal Reserve and the federal government pumped the stimulus packages out to individuals all over the country. But that's not just it, because you might say, Dan, I got a couple checks, but it wasn't enough for me and my family to survive. Well, let me give you two other analyses that happened during this time as well. You had what was called forbearances. Forbearances was a time during this, right through here, where people didn't have to make their mortgage payment. You didn't have to make a mortgage payment for almost 2 years. So think about it. If you didn't have to make a mortgage payment and you have a mortgage, that's going to increase your actually assets quite a bit, or your monthly disposable income. Then behind the scenes as well, remember we had student loans just started paying back now, but student loans didn't have to be paid for almost 3 years during this time frame as well. So think about it. You didn't have a house payment and you didn't have a student loan payment. What bills did you have? Maybe a car payment, some credit cards. But we still had the most money ever in history. Right here, here's the charts. This is by the federal government. Okay, so people were spending and spending and spending, AKA inflation. You have the same finite amount of goods with tons more money chasing those goods. That caused a spike in prices of everything, even housing. Okay, so that's what's going on behind the scenes. But what we're starting to see here is people are starting to not have as much money. The disposable income, you can see, let's dive into this chart a little bit more in detail. Let's just go to 1 year, and I'll get my head out of the screen. Like I said, once again, you can see where it peaked right through here. It was peaking, and now all of a sudden people are starting to use all that excess money that they have, and you're going to start seeing this declining. And then you're also seeing right here where the consumer debt balances, people are starting to spend less as well. So this is nothing but good news for the Fed, because they're saying, okay, now we have people that don't have as much money as disposable income, which we just proved here, and we're having people just starting to spend less, because if you're spending on credit, your credit card rates just probably doubled over the last year since the Federal Reserve has been doing what they're doing. So to put this all in context, people have less money right now. They're going to have to spend less because their credit card debt is getting astronomical. That's going to curtail inflation. And then also you wrap it in where we have the shelter price with this stuff, going in at a 5.7 factor when the Federal Reserve is using a shelter factor right here of 8%. So hopefully this all makes sense to you. It's basically an economics 101 class in regards to real estate and the economics behind it. So now let's get over to what is the expectations the Federal Reserve will increase rates at the next meeting, which is coming up in about 2 weeks. And then what's the expectations that they're going to raise them anytime soon? So let's get over to this. What we focus in on here is what the CME is. This is Chicago Mercantile Exchange. They have a Fed Watch tool, and here it is right here, the CME Fed Watch tool. What is this telling us? Well, what's the likelihood the Federal Reserve will change the federal funds target rate at the next meeting? Well, the next meeting is coming up on the 20th of this month, and there is a 95% probability that they will not change rates, because right now the federal funds rate is at 5.25 to 5.5. So now let's look out and say, what's the probability that they'll change rates anytime soon? We click over to this chart and we go through here. Look, 95% probability that they're going to stay at the 5.25 to 5.5 range right through here. And then you can also see it all the way down through these blue cycles. And then what do we see? Well, we see the blue. The blue is basically where the expectations lie, what they're going to do with rates. And again, remember, folks, the federal funds rate today is 5.25 to 5.5. So there is no piece of the puzzle right here showing that the Federal Reserve is going to raise rates anytime soon. And the next piece is maybe Q2 of 2024, they're going to start pivoting and reducing rates. Now, that can also be found in the dot plot. Okay, so let's get over to the dot plot. So what you want to do is go to the CMEgroup.com, markets and interest rates. Then you're going to go to the dot plot. Right here is the dot plot. What I want to explain before this is basically where the Federal Reserve members are telling us where the rates are going to be. Okay, what they do is every meeting they sit down and they start plotting out where they individually want interest rates to be at this time. Okay, in 2023, 2024, 2025, and further out. Well, let's look at this. This is from the Fed, folks. Okay, right now they're saying that they want the federal funds rate to be between 5.5 and 5.75. Okay, we're at 5.5 right now. So that's why everybody keeps saying, well, there's probably one more rate hike in store for us. However, let's get over to 2024, which is just 4 or 5 months away. This is from the Fed. Where do they expect rates to be next year? Well, if you go across through here, 4.25, 4.25 from 5.5. So what does that mean? This is telling us that the Federal Reserve themselves are saying that they're going to reduce rates between now and the end of next year by 1.25%. from the Fed. Okay, so that's why based on all this information I just provided you, I don't think the Federal Reserve has any more rate increases in store for them. So let's get over to rates again and figure out where rates are and where my expectations are that they're going to go. So we go over to here. This is Mortgage News Daily, where they survey lenders all over the country and they ask them this question. They're like, if you had a borrower looking to buy their first house, it was the primary home, and they're a first-time home buyer, okay? They have a 740 credit score and they're putting down 20%. Now, you don't need to put down 20%. Our average person puts down 5%. But this is the scenario behind the scene. That's what your rate would be. So you might be saying, Dan, what would I qualify for, or do I even qualify for? What I strive to ask you guys is please don't disqualify yourselves. Okay, what I want you to do is visit us or reach out to us and just ask any questions that you have. You might be kicking the tires saying, Dan, is my credit score high enough? Do I make enough money? How much money do I have to have in savings? Well, to answer all these, all I need you to do is do me one of three things. Click the Apply Now button. The Apply Now button isn't going to launch you to an automatic website that's going to, put in your application. What it's going to do is it's going to ask you some questions so you can think about it and say, am I ready? Do I have enough money? Is the time frame I'm looking for, relevant in this situation? It's going to link you to a calendar with us so we can have a one-on-one consultation with you to answer any and all the questions that you have. But you might say, Dan, by the time I get home, I don't have time to, do that or whatever. Can I just call? Well, yeah, you can call. Just scroll down to the bottom of the website and you're going to find multiple ways to get a hold of us there. One, you can give us a call at 844-775-LOAN, or you can reach out to me directly at dan@therateupdate.com. So I hope you find value in my videos on a daily basis, the economics behind real estate and why what's taking place today is taking place. So please join us every day on this. If you'd like to do that, please don't forget to subscribe down below. So every time I post a video, you get an alert. Thanks so much for watching, folks. God bless. And I can't wait to see you here next week as well. Take care. See you then. Bye-bye.